Hello everyone, once again welcome to Italy. We're going to talk today about the subject of participation exemptions or holding company regimes. More or less the same thing or similar. Basically, here's the idea. Typically, if you had a dividend paid out and received, that would be taxable, right? So for example, let's just say at a really simple level, I have a dividend that's in a company in my country, it pays a dividend to me, I pay tax, right? Now, very often what you would have is if you had that company was owned by another company, they could receive dividends tax-free. And this makes sense because you don't want to double tax it through 5, 6, 7 layers of companies, right? The question is, what about if that company was foreign, all right? So let's say that I have a company that is in, I don't know, Bahamas, and it decides to pay out a dividend to a holding company in UK, right? Or Hong Kong or whatever. What's the tax going to be there? Now, obviously if it's in a country where they don't tax dividends at all, then you don't have anything to worry about. But what about if that's not the case? Very often there's something called a participation exemption, which means that if you own a certain share of that company, if you've owned it for a certain period of time, there's certain rules and it'll vary from country to country, then that dividend might be received tax-free or very low tax, all right? So for example, we're in Italy right now. Italy has basically a 95% exemption for the tax on dividends in certain cases, right? Now, why would you want that as opposed to receiving dividends directly? Interesting question. So very often one of the nice things is that what they used to be in the US was they didn't have a participation exemption, which meant that any dividends received from a foreign company were going to be fully taxable in the domestic parent, and that kept all the money outside of the US, okay? The result was, billions, trillions of dollars offshore. So by creating this participation exemption, it encourages companies to bring that money back into the country. From the perspective of the shareholders, this is useful because maybe you want to invest locally, right? Maybe you don't want to invest abroad. And by being able to bring that money back, you get to benefit from it. Now, let's add another couple layers onto this of things that might be really useful. Number one, I'll use Canada as an example, but it doesn't particularly matter. Say you want to qualify for a mortgage, okay? So you want to go and buy a property. Now, normally a small business owner has to pay attention to two sides. They want to show as low income as possible, so they pay less tax. This means maximizing write-offs, etc. But what it also means is that they're less great candidate for borrowing money because they have less income, and usually debt service ratio is a big part of the equation as to whether they'll lend you money or not, depending on how large the loan is you're talking about. Now, in the case of, so the flip side is you show a whole bunch of income, but the problem is then you get taxed a whole bunch. Well, usually there's an ability to show the company's income and say, hey, this is really my income, and therefore use that to qualify for mortgages, okay? The thing is, if you can receive the money into your domestic company tax-free, you can show that you have that high income without paying the tax. You get the best of both worlds, so that's very interesting. The next thing that happens is often you would be subject to double taxation, right? So if I had to bring the money, say, as an example, let's look at the case in the US before the Trump tax reforms at the end of 2017. If you were in a situation where the foreign company maybe paid no tax, then you receive it into a, let's say a US C Corp, which would be a holding company. That company pays tax on it. Then that company pays dividends out to you. You basically got taxed double, right? So you would have been better off, in theory, to receive that money directly, okay? So similarly, let's say that I'm in Canada, right? Canada has had, they've had something called the exempt surplus rules, which is basically this type of a regime, the Canadian standards of it. So you could receive dividends from a foreign company into a local Canadian company. You could pay no tax on that if certain criteria is met. And then when you pay a dividend out personally, now you didn't pay corporate tax, and you're getting a favorable dividend rate. So you end up benefiting. So this is kind of the idea, is that having a participation exemption, having a holding company regime, it's often encouraged by countries in order to encourage other companies to base their investment decisions out of there. But it benefits the locals if you can take advantage of it, because of the fact that you can reduce a layer of taxation, you can show income without having to pay tax on that income. So it works out better from an investment standpoint. And it also, if you're talking about, often what happens is if you were to leave the money abroad and you were to invest it, you would trigger the controlled foreign companies rules. But often by bringing it back, then investing it, you don't have to trigger those rules. So a bunch of different advantages. The important thing to note is just a company locally, under certain criteria, could receive tax-free dividends from a foreign subsidiary. And so the big idea that you want to do is you want to go and you want to find some ways of making the money in a low tax environment abroad and bringing it back tax-free. So that's participation exemptions. If you have questions, reach out to us. We're always happy to help you with anything. We will talk to you soon.